Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his expert in the multifamily space, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing well. So I got a note from a friend of mine who was lucky enough to be invited to a Grant Cardone, super select mastermind, blah blah blah. But anyways, he sent me this because he and I have been talking about multifamily having some pain for 6 to 9 months. So
Hmm.
I'm going to read this, kind of two things, and let you react because I think you've also seen this article. Starts off with 1,457 multifamily properties do not meet DSCR requirements. And what does that mean? Today, it was reported that real estate provider TREP has 1,457 multifamily properties in its database that currently do not meet or barely meet the 1.25x DSCR requirement for their loans. The
Wait, this is what
potential
this
is,
is. Wait, hold it. This is what Cardone wrote.
yeah, this is what Cardone wrote. Yeah.
They stole my post from LinkedIn. This
Oh, he
you can go
did.
look on LinkedIn. It's like verbatim, like what I wrote.
Awesome. Oh, cool. I want the link
Yeah,
to your LinkedIn article. We're going to
yeah,
put that there.
yeah.
So it's funny. Let's see if this is it.
Hmm.
That's awesome. Grant Cardone's taking your stuff, man.
Yeah.
That's for royalty. Let's see if this is in there because I haven't seen your article. The potential is way larger than the mere 1,457 properties identified by TREP. Some 1 trillion of real estate loans will mature in 2023 and 2024 across all flavors of commercial real estate,
Oh
and a
God, they
substantial
just
amount.
literally. I'm getting my post up now because they literally just copied
Oh, that's
like
funny.
my post. This is so funny.
All right,
Yeah,
so I've actually just given you power to share if you would like to share, because we're going to show you. We're going to see what you posted. Extend
yeah.
and
No.
pretend won't work as well in this crisis because interest rates are rising, not falling.
Oh
That's in
God,
your.
this is so funny. Oh wait, hold
Oh,
on. So
you're famous now.
wait, hold. You know what? I think we should read this at the same time, and I'll read from mine, and you read from Grant
Well,
Cardone's.
actually, you could
And
share it so we can see it came from yours. So that's
oh yeah, so hold on. Can you give me
yep,
power to
I
share
did.
screen?
I did.
Okay, all right, and all right, hold on.
This
So
is funny.
let's see, is this it? Hold on, let's see. Yes, okay. Can you see this? Can
I
you see
can
this on
look
the
at
screen?
you. Yep.
Yeah. So whoops, sorry about that.
Oh, it was there.
Yeah.
Okay. Yep.
Um, I need to get rid of this bar here. So you see, this is posted 3 days ago,
Mm-hmm.
and I posted it in my Facebook group before that. So just read what Grant Cardone wrote, and we'll see how close it tracks what I said.
So it said. Oh wait, where'd it go? So today it was reported that real estate data provider TREP has 1,457 multifamily properties in its database that currently do not meet or barely meet the 1.25 DSCR requirement for their loans.
Yes,
So he
that's exact.
does it.
That's almost verbatim. They changed on to four.
Yeah. And then the
Okay.
next line he doesn't have. So I love what you
Okay.
have
All
here.
right.
This
All right.
translates to 18.6 billion in debt. That's good to know. He does not have that. He doesn't
Yeah.
make it. And then it's just funny because it actually jumps down to
Yeah.
the potential is way larger than the mere 1,457 properties identified by TREP. Some 1 trillion of real estate loans will mature in 2023 or 2024 across all flavors of commercial real estate, and a substantial amount of that will be multifamily properties. These properties will need to refinance in a higher interest rate cap rate environment that existed when obtained the original debt. Extend and pretend won't work as well as the last crisis. Yeah,
This is so
I'm gonna
hilarious.
I'm gonna actually
Is it?
ask my guy because he may because again my guy sent me this. I
Yeah.
have no idea. Maybe Grant Cardone put up your post. I don't know.
Okay. All right. That
Because
would
I was
was
just given a picture of it. Uh,
which would be great if he did, obviously.
I'm gonna
But
ask.
if I'm sure Grant Cardone personally did not
Oh
copy
no,
this, it's
no, no,
probably
no,
his
no.
one of his flunkies who did. But
Yeah.
still, it's great. It's
So
really
tell
funny.
us what you see here. Why is this? Why is this exactly what you and I have been talking about in
Yes.
multifamily for 9 to 12 months?
Yeah. So just a very quick refresher for context, and for anybody who hasn't, heard our previous podcasts on this. So when you get a commercial loan, right, it is not sufficient just to pay back your debt, right? The bank wants you to have a cushion above paying back your debt. And that usually is a cushion of 1.25x whatever your debt service is. So let's just say, for example, if your monthly debt service is, principal and interest payment together is $1,000 a month, you need to have net operating income of $1,250 a month for the bank to be happy, right? And so if you drop to, $1,100 a month, and even though you pay your whole $1,000 debt service, the bank is not going to be happy, and they are going to do something that's called pushing you into cash management, where they take over your whole bank, all your bank accounts, and it's really horrible. It's happened to me. And so, but you can't get the debt in the first place. What's really significant about this is that you can't get the debt in the first place if you don't meet that 1.25x, right? For most loans, right? There are some loans that have a lower requirement, say like bridge debt, where they're expecting you to refinance out, right? And so it's
let's be very clear. I think the most acute pain is actually not on what you have here, but it is the bridge debt. That's a whole nother kettle of fish.
Yes. I mean, absolutely, that is true. But just in terms of this, so what is going on here? The reason that this is significant, that there are almost 1,500 properties in TREP's database that they know about, right? There are probably more. But they're
not less,
in their database that are at 1.25x or less. The reason this is significant is because now I don't know, because I didn't see the original data. I just saw it reported somewhere else.
Right.
That the probably what's going on is there are people with variable rate debt that now, that because of interest rates have gone up, right? Their DSCR, the amount of NOI that they had to hit to keep their DSCR on where the banks want it just went up, but their NOI didn't go up that fast, right? So now they are on the verge of either A, being in trouble with the banks, right? And the trouble can range from, being put into cash management, to having the sponsor kicked out and the bank forcing you to sell, to a whole other range of things. Or if you are at the point where you need to refinance your debt right now and you are not at that 1.25x requirement, you are going to have to put in additional capital just to refinance your deal. And a lot of people are not going to be able to do that. Now, when we talked in the last segment, for instance, about deals that are not, like, a lot of people have made a lot of money in real estate over the last couple of years with deals that don't actually perform, right? Because there's always some greater fool willing to pay for the property and bail you out. Mm-hmm. Now, imagine a scenario right now where you are in a deal that is not performing very well, right? And frankly, if you were at a 1.25 DSCR, you are likely not making any distributions to your investors at all.
You shouldn't be.
Because well, you can't. Because, just the CapEx and stuff that's above the line, it doesn't go into the NOI calculation, is probably going to account for that much, right?
It's got to go somewhere. Yep, exactly.
Right. So it's unlikely that you are distributing every penny over your debt service, right? Because there's always stuff that's happening on the property that you need to pay for, those unexpected capital items, et cetera, that are coming out of that cushion, right? So if you're in a deal right now where you're at the 1.25x, you're not getting paid on your investment, right? And your whole play, essentially, you're anticipating getting paid on the sale or refinance. Well, not only is that now out of the question, very likely you're going to get a capital call when they go to refinance, and you're going to be like, why am I going to put additional money into this deal? Because it's not performing very well, right? Why would I put more capital in here? I'm already not getting a return on the capital that I put in. Yeah. So what that means
throwing
is
good money after bad is what they call that.
Exactly. So that means that these deals will not be able to come up with the additional capital that they need to cover the gap in their refinancing, and they're going to go to some kind of forced sale or potentially foreclosure. And this is sort of like the tip of the spear of what we've been talking about for a long time. That's why this is so. That's why this is so. Yeah, exactly. And this is why, if you look, I got 47,000.
Wow.
Yeah, views on this, including obviously Grant Cardone.
The Grant Cardone teams.
Yeah, I mean, this got
again,
me shared by people.
In fairness, they may have shown your thing. My guy just sent me the notes.
Yeah.
I don't want to call anybody out for plagiarism because I wasn't there. For all I
Yes,
know, they
this is
had
true.
your post up. I don't
Yes,
know.
that would be very nice if they posted it and they credited it to me.
Yep.
We'll see. But it was reshared by people like the head of family office wealth management at Citibank, like some people like that reshared it. So it got to a lot of people, obviously.
Awesome.
So and anyway, so this is
Yeah.
the reason that this thing went viral and got to people like Grant Cardone is because this is basically like the proof of what we've been talking about for a long time, that interest rates are going to cause
pain.
Like they're going to not just pain, but I mean we're going to have like foreclosures, we're going to have forced sales, where pricing is getting lower. I mean, pricing, not when I say pricing, what I mean is like cap rates, the trading cap rates. I mean, the dollar amount still may be high, but the cap rates at which deals are trading is expanding, which means that they're not making as much on the sale as they anticipated, right? And so it's all starting now, folks. And
this is what we've been talking about. Yay!
Yes. And as we said in the last segment, the Fed is not pivoting right now. The Fed did not pivot. People looking at this, and people who are in these 1,500 deals, they're the ones who are like all,
wishful thinking,
trying to talk the Fed pivot into existence, right? Because it's the only way they get bailed out. But I'm sorry, folks, like this isn't going to happen. And unfortunately, if you are in a deal where your sponsor was not cautious enough to buy a rate cap and kind of stop the bleeding, and even if they did, the rate cap they bought may be too high anyway. Like they may have bought a rate cap that still puts them into trouble, right? Just because you got a rate cap doesn't mean that you're not in trouble right now, right? So
so this is the tip of the spear. I actually think this gets worse from here. I also think there's all kinds of bridge debt that's not in these numbers that's even worse and will blow up first. We're going to have a cascading of dominoes here. All right. To your ending here, right? The opportunities that are coming in 2023 and 2024, get ready now, because there will be forced sales. There will be, to your point, one of the things you talk about is getting to know brokers. This is the time to do that work. So, Jonathan,
also, I'm sorry. I want to just like let people understand, like, this isn't just a problem for like the big guys or an opportunity for the big guys. If you are out there and you are buying, fourplexes, sixplexes, whatever, the same phenomenon is happening there, just at a smaller dollar number, right? But
I think it has to be commercial. So I don't know that I would say fourplexes.
Right.
So 5 and above.
So 5 and above. But what the point I want to make is that if I don't want you to be looking at this video and saying, okay, well, Twombly is out there doing the big deals and there's all that opportunity, but there's not for me. That's not true.
I agree 1,000%.
For small deals, the same thing is going to happen. You're going to find people who bought their 5-plex or their 10-plex with a small balance loan from a community bank, right? They've got those deals are like 5-year paper, never more than that,
never more.
So they're all full recourse loans, right? So they are there are going to be a lot of people in that situation who they haven't syndicated these deals. They don't have
this is theirs.
Right. They don't have any investors to turn to make a capital call, right? When they refinance that debt and the bank is like, hey, you need to come up with another $100,000, right?
Yeah, or even worse. So again, I've been through this cycle, and again, the biggest stuff we've ever bought was 20 doors. I expect to buy my biggest in this cycle, maybe 25 to 40 doors, just Olivia and I. But we had a loan it was on a 10 unit that the 5-year paper came due in, like, I don't remember, it was like 2011 or something. And we went back to refi it with the bank, who we've never missed a payment, all these things. And the bank said, we don't lend in Fresno anymore. So, thankfully we had relationships at other banks and we got the deal done, but we still had to add $50K to the deal to bring down the debt. I mean, there would be people that are refi that their bank just says nope. And if people go back and watch my playlist, I think this was with the Lumberjack Landlord. he and I have relationships at community banks, and my community bank told me 50% of their small balance commercial loans are not going to be refinanced when they come due.
Wow. Wow.
He showed me. I went there. It was like 3 or 4 months ago. We had to do our balance sheet and personal financial statement. And he said, "Hey, you got some time?" I'm like, "Sure." He's like, "Hey, here's my loan book. Right, you and Olivia are good. Right, you're on the good column. But look at all of these that we will not refi." I'm
Wow.
like, "Wow."
And were
That's
those
a problem.
what when they say commercial though, are those retail like restaurants, things like that?
I
Or is
didn't
it
ask.
yeah.
We always talk multifamily. It would have been predominantly multifamily,
Oh,
but there could have
really?
been some
Interesting.
small
Wow.
strips there.
And why
It's
was that? Why were they not
the,
going to refinance those
the
deals?
bank wanted out of that business. They wanted to be. They felt they were too concentrated. Was the word that they used.
Oh,
Right.
that's interesting as well. I mean, I hadn't, that is like another thing I think we're going to have to look out for because the banks,
Yes.
everybody piled into multifamily, right? And if they have
Exactly.
any kind of like, if they had, because especially during COVID, I mean, first of all, there was like
Yeah.
the run up of multifamily, right? But then there was COVID, so nobody wanted to be in hotels or office or retail or restaurants
Exactly.
or anything else,
Too
right? And they all
concentrated.
piled into multifamily, and now they've got to rebalance, right? They don't want to
Exactly
be
right.
so exposed to multifamily, so they're just going to say, "Sorry, you
Yep.
weak performers." But anyway, what that means is opportunity for you, right?
Ding 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 ding.
Yes, opportunity for you, even more than I thought there was going to be because I wasn't even thinking about this thing. So thank you, Michael, for that. I mean, and look, there is an analog here for the big deals as well, which is that the government backed, like the Fannie and the Freddies, right? They actually lowered their allocation recently
They did.
for debt, right? I mean,
Yep.
so there may not be as
It's gonna
much
be fun.
funds out there for
Yeah.
refinancing, and at the same time, the bridge lenders are all taking a beating,
Oh,
so
oh
they're not.
man.
So they're going
Yeah.
to be out for a while. I mean, this is
Yeah.
this. I think this could be worse than people were thinking. So, and
Oh,
when I
it's gonna
say
be a couple of
worse,
years of opportunity. Yeah.
that means good for you if you are not having to refinance anything and you're just able to buy. And if you have dry
And you
powder,
raised capital when Ray Dalio said cash was trash. I raised capital, and I'm glad I have some trash on the sidelines. Jonathan, you and
exactly.
our time is coming. We've been talking about this since 2019. I'm ecstatic. I know you are. Where can people follow you?
Yeah. So if you'd like to get on my mailing list and see what I've got to say, you can get
Follow
this
him on
free
LinkedIn,
download.
clearly.
Oh yeah, well yeah, come read my article on LinkedIn, find me on LinkedIn, connect with me. I'm happy to connect with you. So, but if you would like to get on my mailing list, please, you can get the ultimate checklist for how to do your first 100-unit deal. I mean, frankly, even if you're not doing deals that are 100 units, you'll learn from this.
Oh,
It's
I
the
read that
same.
a couple of months ago, and
Yeah,
I've never done anything bigger than 20. I thought it was awesome.
it's the same process.
Kidding.
It just people love the idea of 100 units, but whatever kind of property you're buying, this will help you, kind of with the checklist. And you can also go to my brand new Facebook group, which is also called Apartment Investors Club. Oh, I'm sorry, I didn't tell you where to get this. Go to apartmentinvestorsclub.com to get that download. And you can come to the Apartment Investors Club Facebook group. And in that Facebook group, in the guides section, you will find a 4-part video series on how to do a syndication, how to find the best deals from brokers, how to raise money, and the mindset that you should adopt to be successful in multifamily real estate or any real
Awesome.
estate for that matter. Yep.
Thank you, Jonathan.